few days ago, I walked into an open house just to look around. You know how it goes. Free air conditioning, maybe some snacks, and a chance to imagine a life you're not sure you can afford yet. On the kitchen counter, there was a brochure. Nice paper. Clean design. Big, bold headline. Perfect starter home. I glanced down at the price. $750,000. And I actually laughed out loud. Because at some point, we all need to ask the same question. When did $750,000 become starting out?
Hi, I'm not here to sell you a house. I'm here to do something much simpler. Let's break the numbers and see who this actually works for in 2026. And even if you're nowhere near this price range, don't click away yet. Because what's happening here, it doesn't stay here. It trickles down.
Step 1. The entry ticket.
Let's start with the part nobody likes to talk about. The down payment. Traditionally, that's 20%. On a $750,000 home, that's over $150,000 in cash. Not invested, not theoretical. Cash. Ready. Now pause for a second. Because the average household doesn't have anywhere near that sitting around. So right away, most people aren't choosing not to buy. They're simply locked out before the game even starts.
Step 2. Okay, I'll just put less down. Fair enough. Let's say you go with 10%. Now your loan is bigger. And you unlock a bonus feature called PMI, Private Mortgage Insurance, which is basically a monthly fee that protects the bank, not you. That's a few $100s every month, often for years. Step 3. The monthly reality. Now, let's stack everything together. Mortgage payment, property taxes, insurance, maintenance, PMI. All in, you're looking at roughly $6,000 per month. And that's not luxury living. That's just living in the house. Step 4. What income do you need? There's a common rule. You shouldn't spend more than 30% of your income on housing. So to comfortably afford $6,000 per month, you'd need around $250,000 per year. That puts you in the top slice of earners. Not middle class, not average, top tier. Step 5. So who is actually buying? Because here's the confusing part. These homes are still selling. So who's buying them? It's usually one of 4 groups. People who already owned property and are rolling equity forward. Dual high-income households. Buyers getting financial help from family. Or people stretching way beyond what's comfortable. That last group? It's bigger than most people think. Step 6. The hidden pressure. From the outside, everything looks fine. Nice house, good neighborhood, solid careers. But behind the scenes, every dollar has a job. Unexpected expense? Stress. Job instability? Stress. One major repair? Real problem. Because when your budget is maxed out, there's no margin for real life. Step 7. The costs nobody plans for. Owning a home isn't just the payment. It's everything else. Roof repairs, HVAC replacement, plumbing issues, rising insurance, property taxes that don't stay still. A simple rule. Expect at least 1% of the home's value per year in maintenance. That's thousands annually. And some years, much more. Step 8. The mental trap. Here's where it gets interesting. We've been taught something our entire lives. Owning a home equals success. But that idea was built in a completely different time, when homes cost 2 to 3 times annual income, not 8 to 10. So people today are trying to follow a rule that was designed for a different economy. Step 9. The alternative nobody talks about. There's this belief that renting is losing, that you're throwing money away. But here's the uncomfortable truth. Buying a home you can't actually afford? That's also throwing money away, just with higher risk. In some cases, investing the difference between renting and owning can outperform home ownership over time. Final thought. This isn't really about $750,000 homes. It's about something bigger. It's about how the definition of normal has shifted, without most people realizing it. A generation ago, a stable job could buy you a home. Today, even strong incomes are struggling to keep up. So if you run the numbers and they don't work for you, that's not failure. That's clarity. And honestly, that might be the smartest financial decision you can make.